Let's say it's Friday midnight. Your direct deposit clears and you feel a little relief. But in 30 seconds, the auto deductions begin. The rent is paid. The car payment is taken out. Drafts of auto insurance premiums. The utility bill arrives. Before you awake Friday morning, the money that technically arrived 12 hours ago has already been claimed. Your checking account number is now where it was. You are seated with a balance that has been wiped out by decisions you made months, even years ago. And when you look closely at those payments, you see some of them are higher than they should be. Not because of a service upgrade, but because of a 3-digit number attached to your name that you have never seen printed on a bill. That number is your credit score, and it's the most expensive rating you will ever get in your life. You're not inept with money. You're not struggling. You are struggling because the system was designed for you to struggle. Public education eliminated financial literacy. The mechanisms of credit were deliberately intricate. The institutions that profit from them set the default settings on every account you open, the minimum payments on your credit cards, the long repayment terms on auto loans, the interest rates on your savings accounts. You are not confused by accident. It is the result of a process designed for extraction, not for education. The history of the credit scoring system provides context for how we got here. Until the late 20th century, credit decisions were generally quite subjective. You went into a local bank, sat down with a loan officer, and your approval was based on your personal relationship, your family name, or the subjective opinion of the bank manager. The FICO score was created by the Fair Isaac Corporation in 1989. The promise was neutrality, an objective algorithm, mathematical, that would weigh risk on the basis of credit behavior alone. But while the FICO score took the human bias out of the first decision, it created a centralized, automated extraction mechanism. The algorithm became the gatekeeper, and the banks soon realized they could use this 3-digit number to rank society into tiers, charging the highest fees to those least able to afford them. Today we're following that sorting system out. We will now get into the precise math of how the banking system treats you at every single level of your credit score, from 500 to 850. Level 1. The subprime PIC credit score, 549. Here is the bottom of the financial pyramid. Traditional banks don't see you as a customer at this level. They see you as a threat. Applying for a credit card at a major institution, an algorithm will reject your application instantly, in milliseconds. If you need a vehicle, you are locked out of manufacturer financing. You're stuck at buy here, pay here car lots that don't run credit checks but charge interest rates approaching usury. Experian's automotive finance data shows that deep subprime borrowers pay an average interest rate of 16% for new cars and more than 21% for used cars. Let's do the math. Take a $40,000 car and finance it for 72 months at 16% interest. You have a monthly payment of $870. You'll pay $22,600 in interest alone over the life of that 6-year loan. A prime buyer financing the same vehicle would pay $638 a month and pay $5,900 in interest overall. That's a $16,700 difference in interest on the same metal, rubber, and glass. That's $16,700 of your capital down the drain, and it's all due to your score. Many subprime auto lenders also will put GPS tracking devices in your vehicle. These devices are part of starter interlock systems. If you are a day late on your payment, your lender can disable your ignition remotely, and you cannot go to work. You are paying a premium for the vehicle, and you are relinquishing physical control of your asset to the lender. The system does not recognize you as the owner, but as a tenant of your own car. Level 1's extraction also invades your basic living conditions. If you try to rent an apartment, landlords who use tenant screening software will automatically reject you. You have to pay corporate guarantor fees to services that act as co-signers to get housing. These services charge non-refundable fees of 70 to 110% of 1 month's rent. Your rent is $2,000, you have to write a non-refundable check for $2,000 to a corporation just to be allowed to sign the lease. Or landlords will ask for 3 to 4 months of rent in advance as a security deposit. That's $4,000 to $6,000 of your cash tied up in the landlord's account for years and earning 0 interest, all because of your score. Stage 2. The probation of the high risk. Credit score 550 to 599. Here you are away from the absolute bottom, but the system still takes money away from you every chance it gets. Lenders will approve your applications, but they do so with huge markups. You still don't have access to traditional credit cards, but you are starting to receive offers for subprime credit cards. These cards are to be extracted. They charge $75 to $100 a year, $6 a month in maintenance fees, and an application fee to open the account. Their initial credit limits are often $300, which means you have less than $200 of available credit on day one after the fees are deducted. The interest rates on these cards are often 29% or higher. Let's take a closer look at how these subprime credit cards extract money. If you have a balance of $200 on a card with a 29% interest rate, and you only make the minimum payment of $15, the interest charge on your first statement is $5. So of your payment, only $10 actually reduces your debt, and $5 goes directly into the lender's pocket. You'll pay over $50 in interest alone on a tiny $200 balance over the course of a year, besides the $99 annual fee. The card issuer is making a 75% return annually on the capital they loaned you. This is not a service that helps you rebuild credit. It's a high-yield extraction machine that preys on vulnerable borrowers. Level 2 also charges security deposits for essential services. When you set up utilities for a new apartment, the electric company, water utility, and internet provider will do a credit check. Because your score is below 600, they will require security deposits of $150 to $300 per utility before they will turn on the services. These deposits must be paid in cash in advance. This ties up hundreds of dollars of your working capital. Your car insurance premium is affected as well. Most states have insurance companies that use credit-based insurance scores to set the price of their policies. Actuarial data shows that subprime credit drivers pay 50 to 80% more than prime credit drivers, even if the two drivers have the same driving record and drive the same vehicle. You're not paying more for car insurance because you're a dangerous driver. You're paying more because the insurance company uses your credit score as a proxy for financial stress. They assume that a low credit score means a greater likelihood of filing a claim and price that risks directly into your monthly premium. Level 3. The fair threshold credit score 600 to 639. This is the almost prime. You are denied basic services and still heavily penalized. Lenders put you in the moderate risk category, which means you pay a significant premium on every loan. According to Experian data, the average interest rate on near-prime auto loans is 9.57% for new cars and 14.49% for used cars. If you buy a used car at level 3 for $25,000 and finance it over 60 months at 14.49% interest, your monthly payment is $588. That's $10,300 in interest over 5 years. A prime buyer financing that same used car at 9.98% interest pays $531 a month and $6,800 in total interest. A near-prime credit score costs you an additional $57 a month and an additional $3,500 in interest over the life of the loan. This is also the level at which you qualify for a mortgage. Getting a conventional mortgage is tough if you want to buy a home. Instead, you're funneled into loans insured by the Federal Housing Administration. These loans do allow lower credit scores, but at a big financial penalty in the form of mortgage insurance premiums. The Federal Housing Administration loan requires an upfront mortgage insurance premium of 1.75% of the loan amount. Just borrow $300,000, and on your loan balance day one, you have $5,250. You'll also pay a yearly mortgage insurance premium, which is included in your monthly payment. If you put down less than 10%, you are covered by Federal Housing Administration mortgage insurance for the entire 30-year term of the loan, whereas traditional private mortgage insurance is dropped when you build 20% equity in your home. Let's run the numbers on that life insurance requirement. If you are paying $150 a month in mortgage insurance for 30 years, you are paying $54,000 in non-recoverable premiums. That's $54,000 of your money lost forever to protect the lender against your default, with no benefit to you. Let's take a deep dive into the mortgage math. Suppose you buy a house for $400,000 and get a $320,000 loan for 30 years. At level 3, a lender might give you an 8% interest rate. Your monthly principal and interest payment is $2,348. Your total interest paid over 30 years is $525,000. The house itself was $400,000, but the privilege of borrowing the money cost you $525,000 from the bank. The house will cost you $925,000 in total. Level 4. The Prime Gateway. Credit score 640 to 679. Here, lenders start to see you as a good prospect, but they won't offer you their best rates. You're eligible for standard mortgages and conventional auto loans, but you're still paying a secret markup. The bank is no longer saying no to you, but it's not fighting for your business either. Mortgage interest rates at level 4 are around 7.2%. Let's do the same mortgage math on $320,000. At 7.2%, your monthly payment for principal and interest will be $2,172. So now you've paid $462,000 in interest over 30 years. This is $63,000 less than the borrower at level 3, but it is still significantly higher than what prime borrowers pay. If you put down less than 20%, you also have to pay conventional private mortgage insurance at this level. Your FICO score also determines your private mortgage insurance rates. A borrower at 640 pays a much higher rate than a borrower at 740. For a $320,000 loan with a 640 FICO score, the rate for private mortgage insurance will be about 1% of the loan balance a year, or $266 a month. At a 740 score, the rate is 0.3%, or $80 a month. That alone is costing you another $186 a month for insurance that protects the lender, not you. That additional monthly payment increases your debt-to-income ratio, which then decreases the maximum amount a bank will permit you to borrow for a home, constraining your options in the housing market. Fifth level. Good standing. Credit score 680 to 719. This is the start of the prime tier. Most American lenders will approve your applications with little friction. You are a low-risk borrower and are approved for standard advertised interest rates. Experience says the average interest rate on auto loans at this level is 6.27% for new cars and 9.98% for used cars. On a new car loan of $40,000, 72 months, your monthly payment is $706. The total interest cost on that loan is $10,800. This is half the interest cost of the deep subprime level 1 borrower. Your mortgage rate at level 5 is going to be about 6.8%. Your monthly payment on our $320,000 mortgage is $2,086. You've paid $431,000 in interest in 30 years. You can get high-level reward credit cards and apartment leases without any extra deposits or guarantor fees. The banks like you, but they still won't give you their best deal. Level 6. The Superprime Elite Credit Score, 720 to 759. This is the real financial leverage. You are a good customer from a lender's perspective. You are now not only qualifying for loans, but banks are actually competing for your business. Level 6. I give you offers for premium credit cards with large sign-up bonuses, 0% introductory interest rates, and premium travel benefits. If you use them correctly, these 0% deals are a great weapon. They provide them because they believe you will carry a balance when the promotional period ends. An industrious debtor can borrow the bank's money for a year or a year and a half for free, while putting his own money in 4% savings. The system is built to trap you in debt, but your credit score is the shield to exploit the system to your advantage. At this level, your mortgage rate is about 6.5%. That mortgage is for $320,000, and your monthly payment is $2,022, and over 30 years you pay $408,000 in interest. You only save yourself over $117,000 in interest compared to the borrower at level 3, all because the banks trust you. Level 7. The Executive Sanctuary. Credit score 760 to 799. This is the top of the normal credit pyramid. Here you'll receive the lowest interest rates available in the market. Lenders know the statistical probability of you defaulting on a loan is near 0. Level 7 gets you the prime mortgage rate of 6.3%. Let's do the mortgage math one more time. The monthly payment on a $320,000 mortgage at 6.3% is $1,980. Over 30 years, your total interest paid is $393,000. Let's see the level 7 borrower versus the level 3 borrower. The level 7 borrower pays $1,980 a month on the very same $320,000 loan. The level 3 borrower pays $2,348 monthly. That's $368 a month, every month. Over 30 years, the level 3 borrower pays $132,000 more in interest. That is $132,000 of capital taken out of one household and put into the bank's vault. The other household keeps that money and invests it. That's how the credit system quietly widens the gap between the rich and the poor. 8th degree. Sovereign's peak credit score, 800 to 850. This is the absolute maximum of the credit system. 800 score won't mean lower interest rates than a 760 score on a mortgage or auto loan, but it is the last word in margin of safety. At level 8, your relationship to the banking system changes. You are no longer an applicant looking for approval, you are an asset. If you apply for a loan, it will be approved automatically and instantly. You have tremendous buying power, with credit limits on individual credit cards frequently $30,000 or higher. More than that, you hold the leverage to bargain. If a lender is charging you a slightly higher interest rate than a competitor, you can call them up, show them your credit profile, and demand they match the lower rate. Most of the time, the bank will go along because they don't want to lose a customer with a perfect credit history. In addition, Level 8 provides a cushion for the unexpected. A credit bureau error on your report, or a glitch in a bank transfer that causes you to miss a payment, could cost you 40 points. That drop would move a borrower at 740 into the near prime tier, which means higher interest rates on future loans. A borrower rated 840 falls 40 points to 800. They stay in the Superprime tier and see no change in how banks treat them. The sovereign peak isn't about getting cheaper loans than Level 7. It's about having your financial peace of mind. Let's see who really benefits from this system. The three credit bureaus, Experian, Equifax, and TransUnion, are not government agencies. These are private companies for profit. Their customers are not the consumers whose data they are harvesting. Their customers are the banks, the credit card companies, the insurance companies that buy the credit reports. The bureaus gather your financial data without your specific consent, bundle it into a score, and then sell it to institutions that use it to price their products. The bureaus have no financial incentive to make sure your report is accurate or to teach you how to improve your score. Their profit is from the transaction of your data. This is why the credit reporting system is riddled with errors. The Federal Trade Commission's study found that 1 in 5 U.S. consumers had a verified error on at least one of their credit reports. These are not minor spelling errors. Late payments are reported incorrectly, closed accounts show as open, collection accounts that belong to someone else, and duplicate balances. If your score drops from 760 to 680 because of an error on your report, a private company's data entry mistake ends up costing you tens of thousands of dollars in extra interest. In addition, credit bureaus have automated systems in place that make it difficult for consumers to correct errors. The bureau seldom reviews a dispute you submit. Instead, they use an automated system called eOscar, which stands for Online Written Submission of Conflict Acquisition and Resolution. The system takes a look at your dispute letter, translates your detailed explanation into a 2-digit code, and sends that code to the creditor. The creditor checks their database, sees the code matches their records, and denies the dispute. The whole process is automatic, and the whole burden of proof is with you. The 2017 Equifax data breach underscored this systemic disregard for consumer protection. The credit bureau neglected to patch a known security vulnerability, exposing the personal information of 147 million Americans, including social security numbers, birth dates, and addresses. The very companies that track our creditworthiness could not protect their own systems. But even with the breach, Equifax is one of 3 gatekeepers to the American financial system. You have no way to opt out of their tracking. You can only learn the rules to their game. Another extraction mechanism is the gathering industry. Debt collectors purchase old, unpaid debts from credit card companies and utility companies for pennies on the dollar. These debts are often past the statute of limitations, which means the collector can't sue you for the money. This is called a zombie debt, but collectors will report these accounts as new collections on your credit reports. It lowers your credit score and forces you to make a payment. If you make even a $1 payment on a zombie debt, the statute of limitations resets, and the collector can sue you for the full balance. The collection system is set up to prey off your fear and ignorance of the law, to get you to pay on old liabilities. But we do have historical proof that you can build wealth by learning and master keying this system. Take Sylvia Bloom, for example. 67 years she worked as a legal secretary in Manhattan. She saw the lawyers for whom she worked making money by purchasing stock. She also didn't have a degree in finance, and she didn't have any inside information. She just watched what they bought, and if they bought something, she would buy herself something similar with her much smaller salary. She did not trade. She did not freak out when the market crashed. She did not try to time the market. She just bought shares and kept them. When she died, her estate was worth more than $9 million. The lawyers she worked for were rich, but she had quietly built a fortune to rival theirs, simply by using the same assets and holding them longer. Then there's Earl Crawley, a parking lot attendant in Baltimore who earned $12 an hour for most of his career. He knew that there were rules in the financial system, and if you played by those rules consistently, the math worked. He lived simply, packed his own lunch, rode the bus, and invested small amounts of money in blue-chip stocks through a local brokerage house. By the time he got into his 70s, he had over $500,000 in investments. He didn't let the system steal his wealth, and he used the system to make his own. And think about the story of Grace Groner, a secretary who purchased 3 shares of Abbott Laboratories stock in 1935 at a total cost of $180. She didn't sell them during the Great Depression or World War II or the high inflation of the 70s or the dot-com crash. Instead, she chose to automatically reinvest each dividend check to purchase additional fractional shares. Over the next 75 years, those 3 shares split many times, increasing the number of shares she owned, while the dividends kept buying more. By the time she died in 2010 at the age of 100, her original $180 investment had blossomed into a fortune of $7.2 million. She didn't have a team of analysts, didn't spend hours tracking stock charts. She just let time and the reinvested dividends do their work. You have to really take over your credit profile to get out of the extraction. Now it's time to do the 3-step credit audit. First step, visit link and get copies of your credit reports from all 3 of the bureaus: Experian, Equifax, and TransUnion. This is the only official website that federal law requires to provide free credit reports, and it's free. Stay away from commercial websites that ask for a credit card or attempt to sign you up for a monthly monitoring service. The official reports are absolutely free. Second step, read all the lines of the 3 reports. Check the payment history on any accounts. Are the balances correct, and are there any accounts that are duplicated? If you see an error, call it into question right away. When you write your dispute letter, do not use the online portals offered by the credit bureaus. They require you to accept their automated arbitration clauses and prevent you from uploading evidence. Instead, you should write a physical letter and mail it via certified mail. Clearly explain the error. Attach copies of your supporting documents. Ask that the information be removed. Since you sent the letter certified, you have proof of the date it was received. The bureau then has exactly 30 days from the date of receipt to resolve the dispute or delete the item. Don't pay collection accounts unless they are valid and you've negotiated a pay-for-delete agreement. Debt collectors, upon receiving payment, will usually mark your status as paid collection. A paid collection account, though, still sits on your credit report and continues to hammer your score. You have to write a letter to the collector offering to pay part of the debt if they will completely delete the collection listing from your reports. Before you send out a single dollar, get this agreement in writing. Your score will bounce back immediately if the collector deletes the account. Step 3. Maintain a low credit utilization ratio. Your utilization ratio is the percentage of your available credit you are currently using. Your credit utilization ratio is calculated by dividing your total credit card balances by your total credit limits. This ratio accounts for 30% of your FICO score. Lenders want to see you have less than 10% of your available credit utilized. Let's say you have a credit card with a $10,000 limit, and you're carrying a $3,000 balance. Your utilization ratio is 30%, and that's hurting your score. If you pay that balance down to $900, your utilization ratio drops to 9%. Your score will go up immediately when the bank reports the new balance to the bureaus. Building credit does not require you to keep a balance or pay interest. Pay your credit cards off in full every single month. This way you will keep your utilization ratio low without ever paying $1 of interest to the bank. Finally, set up auto pay on all your accounts. Your payment history makes up 35% of your credit score. One late payment of 30 days or more can take away more than 100 points from a perfect score. Automating the minimum payment on all your credit cards and loans ensures that a late payment will never occur, even if you forget to check the bill. You can always manually pay more than the minimum, but the automation is your safety net. The math isn't waiting for the right time. The credit system is on every day, calculating your score and pricing your loans by your history. The system defaults were set in the bank's favor. The exit was made for yours. Setup time is 50 minutes. It's freedom for decades. Now the board is visible. You have the next move.